With financial year 2020-21 coming to an end, many of you will now aggressively make all those investments so that you can save as much tax as possible, right? But have you ever realized that tax planning is much more than just saving your salary from tax liability? If done smartly, your tax planning can fetch you excellent yields over a period of time. But unfortunately, many of us around just rush through this entire process because all we want to do is just save tax. Tax saving should ideally be a year-long process and not just a last-minute exercise to avoid making certain mistakes that could prove to be counterproductive to your financial goals. Postponing tax planning to the end of the financial year carries the risk of making certain mistakes that can derail your entire financial plan. With that said, in this video, we'll talk about the mistakes you should avoid when making last-minute tax-saving investments. Under that, the very first one is investing more than what's required. Do you know how much you exactly need to invest in the tax-saving instruments this year to reduce your tax liability? Estimate your expected total income for the current financial year after factoring in all your income and accordingly ascertain the total tax-saving investments you need to make in the current financial year. Adjust the tax-saving investments you already have made in this year to determine the exact amount to be spent on tax measures. For example, let's say you're spending rupees 36,000 that goes towards your EPF, then rupees 10,000 that goes towards PPF, then rupees 18,000 that goes towards life insurance, etc. So all the investments that you've made, add all those and then calculate how much you will need to save. Investing more than what's required could disrupt your journey to achieve your financial goals in time, while disturbing your core savings could leave you vulnerable to any emergency. The next one is investing in insurance cum investment products. Many people blindly invest in insurance cum investment products like the traditional insurance plans and endowment policies to save tax at the last moment. However, these plans often fetch you lower returns than pure investment instruments like your ELSS, PPF, etc. and their life cover is significantly less than a plain term insurance policy that usually carries lower premium obligations too. Moreover, traditional insurance policies often require a very long-term investment commitment and you will incur heavy losses if in case you surrender them during the initial years. As such, it's wiser to keep your investment and your insurance goals separate. You may go for ELSS, VPF, which is your voluntary provident fund, or other small savings schemes for investments in line with your returns expected, liquidity requirements and the risk tolerance, and a term plan or a health insurance plan for your insurance requirements. The next one is miscalculating your tax liability. Most investors make the mistakes of not including the interest income that they earn from fixed deposits, tax-saving fixed deposits, and recurring deposits, which are completely taxable. Taxpayers do this believing that they don't need to pay any kind of tax because the banks have already deducted the TDS. But however, let me tell you that 10% of TDS does not cover full tax liability for those who fall under the higher tax slab rates. Thus, those who fall under this tax slab rate, they need to pay additional tax as per their rate. Also, the interest earned on balance in the savings account is tax exempt only up to rupees 10,000, beyond which this too is added to the taxpayer's income and it is taxed as per their tax slab. Similarly, not adding capital gains from the redemption or the systematic transfer plan from our liquid funds is another common mistake. A withdrawal that is made before the 3 years of completion is treated as the short-term capital gain and it is also taxed accordingly. Another income that taxpayers usually miss includes deemed rent. Let me tell you that the income tax rules treat vacant residential properties as deemed to be let out and they require the house owners to pay tax on notional rent. Now, up to 2 residential properties are completely exempted from this rule, provided they are either self-occupied or are on vacant. If you have now, for instance, if you have more than 2 homes, then and if they are vacant, then you have to pay tax on the notional rent. The next thing you need to remember, or the mistake you need to avoid is investing using borrowed funds. Tax saving is a crucial financial step, but you must not exceed your financial capacity or capability while doing so. Spending more than what you can afford can create unnecessary debt and hurt your finances. Most people are still recovering from the COVID-19 related financial stress, and they need to continue to have a high liquidity requirement. So taxpayers should try to strike a balance between tax saving and liquidity needs to be at the point. Some taxpayers go to the extent of borrowing money to accomplish their tax saving goals, but this is what you need to avoid. Avoid using borrowings like the personal loan or withdrawing cash through credit card to invest in tax saving schemes. If you must, you may consider borrowing money from your friends or relatives or use an overdraft facility against your FDs or any other eligible investment. If you have any of your investments that are matured, then you can also use that fund to invest in tax saving schemes. However, you should first aim to invest in tax saving measures out of your own savings without disturbing other important financial obligations. The next one is expenditure under Section 80C. Now, before you rush to exhaust the Rs 1.5 lakh tax deduction under Section 80C through investments, you need to check the eligible expenditures that you can claim. For instance, child's tuition fees, then repayment of principal component of home loan, life insurance premiums, all of these qualify for a deduction. Also, if you have acquired or you have constructed a property, then stamp duty, registration fees, and even property transfer expenses are also eligible. Deduct the eligible expenses from Rs 1.5 lakh, and then the balance amount is how much you need to invest to fully utilize Section 80C. The other common mistake most investors do is not diversifying the tax saving investments. Diversification can help you reduce the risk to a great extent when you invest money, whether it is tax saving investment or a regular investment product. Due to the last minute rush, many often put their entire fund in one single asset class. So while investing in tax saving instruments, you need to make sure that you ideally identify or you diversify those asset classes, and then you diversify your assets among different asset classes and even different schemes. For example, instead of putting your entire money in, say, ELSs that carries medium to high risk, you can also consider diversifying your investments by investing in, say, NPS, then tax saver FDs, PPF, gold, etc. in addition to the ELSs to minimize the overall investment risk in the long term, and then you get the desired returns. The next common mistake is not linking the tax saving investments to your financial goals. People often forget to link their tax saving instruments with their goals, which cost them a lot in the future. While investing in long-term tax-saving investments or instruments like PPF, NPS, EPF, ULIPs, life insurance, etc., it is essential to link them to your long-term future goals so that you don't exit in the midway. Even when you invest in, say, ELSs, having a which has a short-term lock-in period, you need to link it with a particular goal and then extend it until you get the desired amount for your goal. Proper tax management can go in a long way towards increasing your returns. But the decision needs to be made in conjunction with your overall portfolio. People rarely think about tax planning from an investment point of view. They usually grab up investments that give them the tax break to help them reach the determined financial goals. Do not make this mistake, and you need to align your investments with your financial goal. The last one is not exhausting all of the tax saving avenues. Apart from Section 80C deduction, if you live on a rent or you stay at your parents' place, remember you can claim the benefit of house rent allowance. Do not forget to claim leave travel allowance exemption, any amount donated under Section 80G, interest paid on education loan under Section 80E, etc. One can claim deduction under Section 80D of up to Rs 25,000 for medical insurance premium for self, spouse and children. Additional deduction for medical insurance for parents can be claimed up to Rs 50,000 if they are senior citizens. One additional point I would like to add here is that many people are unaware of Section 80D is that a deduction for medical expenses can be claimed up to Rs 50,000 for treatment of dependent senior citizens who do not have any insurance cover. So these were some of the common mistakes that one needs to avoid when making last-minute tax planning. To reiterate yet again, tax planning should be a process that has to be carried out throughout the year and not in the last moment of the year end. Also, for those who have just started out their career and have no idea about tax planning entire thing, then we have developed an exclusive course for all of you on tax planning, which is available only on our Financial Freedom app. So hurry up and download the Financial Freedom app either from Play Store or App Store and get access to the knowledge of A to Z detail about tax planning. Also, if you like the content, please do hit on the like button. Do not forget to subscribe to our channel for more such financial content, and do not forget to hit on the bell icon to get notified for our next video. Thank you for watching IndianMoney.com. Get wise, break free.